We have to launch immediately with the headline numbers because today was just the complete mirror image reversal of the week's
A
turbulence.
total U-turn after that post-Fed slide, yes.
Exactly.
Yeah.
Technology stocks just staged this incredible comeback, propelling the Nasdaq Composite up a sharp 1.31% to close at 23,307.62.
And that move completely wiped out the week's post-Fed losses. We're right back where we started, and then some. But for me, the most significant move wasn't even the index climb.
It was the fear gauge.
It was the fear gauge, yeah.
The VIX.
The VIX, it just collapsed. Down 11.62% today, settling at 1491.
Wow.
You rarely see an 11% plus drop in a single session. It's like the market decided yesterday's fear premium was, well, entirely overblown.
But speed is astonishing. Let's unpack that because beyond the Nasdaq, the broad market recovery was really strong too.
It was.
The S&P 500 climbed 0.88%, closing at 6834.50. And if you look at the big picture, that puts the index just, what is it, 1.24% away from its 52-week high.
We are knocking on the door again, and the speed of this normalization is what's really fascinating here.
Right.
That 11.62% VIX plunge, it confirms that traders saw that negative reaction to the Fed as an opportunity, not a long-term warning.
So they were buying the dip.
Buying the dip. And if you drill down into the really near-term expectations, the 9-day VIX absolutely cratered. It fell 24.64% to 1049.
But that low number, it signals practically zero immediate hedging demand. No one's buying protection for next week.
No one. But when volatility collapses that fast, it does make you wonder about the longer-term view. I mean, are traders just ignoring risk for a moment,
Or is this calm expected to last into the new year?
The data suggests they think the calm will stick around. For now, but not forever. At 1491, the VIX is now trading 19.18% below its 50-day average.
Okay, so statistically, we're back in a calm environment.
Exactly. But, and this is crucial, the volatility term structure is still in what we call contango.
Right. And for listeners who might not be familiar, can you just quickly break down what that term structure means in practice? Why does that shape matter?
Absolutely. So contango just means that what traders expect volatility to be 3 months from now is significantly higher than what we're seeing today.
Okay.
We look at the spread between the 3-month VIX and the spot VIX, and today that gap is at 3.34 points. So what that tells you is that traders are comfortable today, but they do anticipate volatility returning over the next quarter.
So maybe tied to earnings season or something early next year.
Exactly. It's a short-term sigh of relief, not a definitive all clear that risk is gone for good.
I appreciate that distinction. So temporary relief. Okay, so if the calm is temporary, we need to know what powered today's rally. And for that, we have to look right at tech.
Oh, absolutely. The sector surged 2.16% to 144.60.
And this is after that nervous reaction to the Fed's guidance on, maybe slowing capital expenditure. Investors seem to have completely reconsidered that.
This is the resurrection of the AI trade we've been talking about. Investors looked at the pullback, decided it was a mistake, and just bought right back in. And the technicals back it up. The tech sector is now trading above both its 50-day and its 200-day moving averages. And what's really critical is how this rally was a complete inverse of what we saw earlier this week. It was a classic, aggressive growth over value rotation, exactly.
And you really saw that play out brutally in the defensive names. The move away from safety was sharp. Utilities were the session's worst performer, declining 1.27% to 42.63.
And that now puts them below both their key moving averages. Consumer staples also fell, down about 0.5%.
It's just a classic signal. When the market believes risk is back on, investors just sell safety and run toward the higher beta names.
And the specific company news today just amplified those moves. It gave a really clear picture of what the market is rewarding and what it's punishing right now.
Right. Let's talk about some of those. Oracle surged approximately 7%. That's on the news about their ByteDance joint venture.
Which suggests just massive upside in their cloud and data deals. A 7% bump for a company that size is huge.
It really is. And then in industrials, FedEx jumped a massive 8.5% after they announced the freight business spinoff. Investors clearly love that.
They loved the move to unlock value. But then you get to the biotech side of things, and that was just a masterclass in capital divergence.
A tale of two companies.
It really was. Novo Nordisk plunged over 19%. That was after their CagriSema trial results. Really disappointed.
And that kind of immediate, drastic drop shows you there's just zero patience for clinical setbacks right now.
None. But the money didn't leave the sector.
No, it just moved down the street.
Exactly. Rival Eli Lilly rose more than 6%. Investors just shifted capital directly to the competitor, figuring Novo's stumble just clears the path for Lilly's treatments.
That whipsaw is just, it's a clear sign that while the indices were up, investors are still being extremely picky at the individual stock level.
Right. And now if we try to connect this, equity euphoria to the bigger macro picture, we run straight into our first major contradiction of the day.
The bond market.
The bond market. In a classic risk-on rally like today, you'd expect safe haven demand for bonds to dry up. But today, Treasury yields actually rose across the board. The 10-year climbed 3 basis points to 4.150%.
And that's the key conflict, isn't it? Equities are cheering, but bond investors are pushing long-term yields higher, which of course had an immediate negative impact on the most rate-sensitive sectors.
Yeah.
Despite the broad rally, REITs were down. The big REIT ETF VNQ fell 0.38%. It just highlights that pressure from rising yields on real estate.
We call that duration pain. But it's important to note the divergence within REITs themselves, which again was driven by tech trends.
The data centers.
The data center REITs. Driven by that relentless AI demand, they bucked the trend. Equinix was up 1.94% and Digital Realty rose 1.39%.
So even within a suffering sector, capital is flowing to areas with that strong secular growth story.
Exactly. And this is where the global picture gets even more complicated. We had a massive currency paradox today out of Japan.
Right. The Bank of Japan raised rates 25 basis points to 0.75%. That's their highest level in 30 years.
Historic move. And typically a rate hike, especially after decades of zero rates, should strengthen a currency. So what happened?
The yen collapsed. USD JPY surged 1.45% to 157.74.
A hike leading to a currency collapse. I mean, it's incredibly counterintuitive. What explains that disconnect?
Well, it's all about the gap between expectations and reality. The market had priced in a hawkish hike.
So the hike plus a clear signal of more to come.
Exactly. They wanted concrete forward guidance, signaling more normalization in 2026. Instead, Governor Ueda was vague. He emphasized caution, data dependency.
And traders hated it.
Hated it. They sold the yen immediately, concluding that the pace of tightening would be far too slow to justify holding it.
So what are the broader implications of the yen suddenly collapsing back into that range?
It puts the pair right back into that critical 157 to 160 intervention warning territory.
The same range where they spent about $100 billion defending the currency last summer.
The very same. And it raises a huge question for global markets. If Japanese institutional investors, who hold massive amounts of U.S. debt, start bringing that capital back home, what happens?
It could put serious upward pressure on U.S. bond yields, which are already rising. That's a huge global risk to keep an eye on.
It's a potential shock just waiting to happen.
Yeah.
Okay, so let's look at other asset classes. Did the equity rally find any confirmation elsewhere? Precious metals, for instance, kept going.
They certainly did. Silver rallied 2.71% to 67.17. It's just extending what's been a historic 2025 performance. Gold edged up about 0.1%.
And we saw big moves in industrial commodities, too, which speaks to that same fundamental demand idea.
Absolutely. Copper surged 2.26% to 5.49. And the real standout was aluminum. It jumped an impressive 5.09% to 29.6750.
Driven by supply constraints and that China stimulus optimism.
Right. These moves speak to genuine economic optimism just below the surface.
And finally, let's touch on crypto, because that decoupling trend we've seen for a few weeks, it broke today.
It broke. The digital assets moved right alongside the major indices. Bitcoin rebounded 2.70% to 87,991.
And Ethereum surged even more, gaining 5.45% to almost $3,000.
And that rally gives us a perfect way to bring in the key technical context, which is really essential to understanding the sheer size of today's move.
Triple witching.
It was December's triple witching expiration, that quarterly event where stock options, index options, and index futures all expire at the same time.
And this was a massive one.
A massive one. It involved a record $7.1 trillion in notional value. That's about 20% larger than December of 2024.
$7.1 trillion. So How confident are we that today's rally was genuine conviction and not just mechanical buying from market makers unwinding their hedges?
That is the critical question. This mechanical flow almost certainly amplified the rally's size and, importantly, the VIX compression.
So as those hedges roll off, volatility just drops mechanically.
It does, which suggests at least some part of today's gains were about technical positioning, not purely new fundamental belief. We have to be careful not to overread the enthusiasm until these effects fade next week.
That is a crucial caveat. Okay, so what about the actual economic backdrop? We did get some solid data today.
We did. Q3 GDP was revised up again, landing at 3.1% from 2.8. That suggests the fundamental support is still robust.
And jobless claims.
Initial jobless claims fell 13,224, a sign of a still tight labor market.
But there's a nuance there, isn't there? Continuing claims, people already on unemployment, it actually went up to 1.897 million.
And that's the signal of gradual cooling. It means people who are losing their jobs are having a tougher time finding new ones. That's exactly the kind of moderation the Fed wants to see, but it also signals potential softness ahead.
So wrapping all this up, where are the key technical battlegrounds we need to watch next week as these expiration effects fade?
For the S&P 500, key support is the 50-day moving average. That's at 67.61. If we break that, confidence could waver.
And resistance.
Resistance remains the 52-week high of 69.2034. A breach there would confirm the bull trend is real.
And on volatility, we're sitting so close to the lows.
With a close. The VIX is flirting with its 52-week low of 1412. Sustained readings below 15 suggest complacency has returned very, very quickly. And then next week is huge for data.
Right, we get GDP revisions, consumer confidence, durable goods.
And maybe most importantly, the detailed FOMC meeting minutes, which will give us insight into that wait-and-see posture.
So the core takeaway is the market has absorbed the Fed's stance, rallied hard, but the internal and global contradictions, they're still there. Rising yields, the stress in the yen, these issues are still brewing.
Absolutely. The fundamental question is whether the Fed's new stance is genuine patience or just uncertainty. And the data next week will be the first big test for the market's conviction.
All right, I think that covers the incredible complexity of today's whipsaw session and the $7.1 trillion technical flow we saw.
It was a very busy session, full of contradictions and massive reversals. That's the daily consolidation for today.
As always, this discussion is purely for informational and educational purposes, so make sure you do your own research before making any investment decisions.
And if you found this breakdown helpful, hit that subscribe button. We're here every trading day after the close, guiding you through the numbers.
See you next time.